You're about to hear my conversation with our CIO of Equities, Leslie Marks. We talk all about the latest tariffs, Jerome Powell's testimony against the Senate Banking Committee, and what the outlook is for the Canadian dollar and equities. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. I'm your host, Matthew Schnurr, and I'm back with Leslie Marks, our CIO of Equities. Leslie, welcome back to the podcast.
Thank you, Matt. I feel like it's been a while.
It does feel like a while, and I'm glad you're here to help us navigate fairly turbulent times, frankly. It seems like every Monday we get some sort of negative surprise on tariffs. This Monday was about tariffs levied on aluminum and steel. Markets negatively reacted to the news, but nothing terribly devastating. What's your take on the tariffs?
I know it's sort of it makes you dread Mondays now even more than
Yeah,
than
exactly.
the average person did, right? Yeah, I don't know if it's that the president gets the weekend to think about all the chaos that he's going to create for the week ahead. Maybe too much time on his hands or something on the weekends, but. Um, I feel you. I hear you. I think we've had a couple of difficult Mondays, the last 3 Mondays anyway. And, maybe we'll just land here on a discussion around the latest Monday scary, which was as you mentioned, the 25% tariffs on aluminum and steel imports into America. Now, first of all, these tariffs are scheduled to come into effect in March. So they're not in effect yet. And there does seem to be a fairly consistent pattern here of a tariff announcement with sort of a window before tariffs come into place. Now, that doesn't really make it any easier to digest because there's a lot of logistics that has to be managed when a tariff is put into place and, what goods, how to collect the tariffs, et cetera. So I think, it makes sense that there's always a time lag between
Sure.
the announcement and implementation. But I want to put a little bit of perspective around some of these tariff announcements because this really ties into your comment around the market not really reacting as negative as we would have thought on the basis of many of these tariff announcements. And I think, and I've thought about this quite a bit, um, the reason for that is primarily rooted in the pattern of a tariff announcement and then kind of stepping back or pulling back from the action. And so the market is getting really conditioned to saying, well, it's probably not going to end up like that, or
Right.
as, in the worst case scenario. And I happen to think that that's a bit of a false logic. And here's why I think that. The first reason is because you have to look at the goals of the tariffs. So, the first reason is the obvious one, which is to encourage more capital investment in America.
Right.
And the second one is really about a fiscal objective, which is to pay for tax cuts. So when I look at those two objectives, which have been such an important part of the president's platform, I don't see those going away. So I think the bottom line is that we really need to expect and assume that there is going to be tariff activity. We don't know, how big, how long, how much, but tariffs are coming one way or another. So that's where I want to start. And then just talking about, if we could double click on the latest announcement around steel and aluminum to get some of the facts on the table. Because this is where the market sort of has a bit of disbelief that this is actually going to come in the way it's been explained. First of all, about 25% of American steel that is consumed in America is imported. So that's a pretty big number,
Right.
but not nearly as big as the aluminum number, which is about 70% of their aluminum is imported. And for us Canadians, that's they're both important, but the aluminum one is particularly important because 60% of their aluminum needs come from Canada. When you look back at history in President Trump's first term, steel and aluminum were also part of the tariff calculus, but there were exemptions and exceptions because, as we all know, um, the reason America is importing these goods is because they don't have manufacturing or access to these goods within their own country.
Sure.
And so the impact of tariffs really is dependent on the availability of substitutes. And so the only substitute is either to shift where you're buying the product from or to manufacture in your own country. And if you take the example of aluminum smelters, like, sounds really nice to think, oh, okay, well, we if you take sort of President Trump's stance, we don't need Canadian aluminum. We can manufacture that ourselves. That is technically incorrect, but implementing that to build an aluminum smelter can take 3 to 5 years, best case scenario. It is an incredible consumer of um, electricity.
Right.
And is that really, where you want to utilize a scarce resource like electricity when you could be using that for higher value applications like data centers, which we know the president is very much focused on. So, the premise is good, but the logic is bad. And I think it's going to take a long time to sort this out, and it's creating a lot of chaos. And yet, as you rightly pointed out, the market doesn't seem to be ascribing a lot of value to the impact of tariffs. The last thing I'll say on this is I think um, while those around in the inner circle in the administration are very much supportive of the tariff mandate, when you listen to some of the CEOs that are most impacted, and I would say those of the automotive industry particularly, those are really important data points. That's an extremely important industry to the United States, obviously to Canada as well. And this week, the CEO of Ford said that the tariffs and policy changes from Washington were leading to, and he used the word chaos for the auto industry. Um, and his exact words were a lot of cost and a lot of chaos from the 25% proposed tariffs on Mexico and Canada. And he also referenced the steel and aluminum tariffs. And I think there's a strong acknowledgement that um, in the automotive industry that the their costs will go up, and that will be passed on to consumers. There will likely be layoffs in that industry as well, and it really impacts the competitiveness of the automotive industry, which is already falling behind some of the global players,
Right.
particularly in China. So, all in all, it doesn't appear to be on balance good policy. And I do think it will have far reaching implications that are not fully reflected in equities.
Got it. So maybe just to double click on that and make sure I understand what you're saying, you think that there's a higher probability of the tariffs actually coming to pass than the market is potentially projecting, and therefore there's likely a market reaction should those tariffs come to pass. Like we're not appropriately priced where we are now for a 25% tariff in aluminum and steel.
Exactly. That's exactly right. And actually, in late breaking news, you asked the question in the context of the tariff announcements over the weekend. But now we're moving to scary Thursdays. And, today being Thursday, we did have another announcement from the president on his social media platform that reciprocal tariffs would be coming today. And so this is another tariff policy related to the US basically implementing tariffs to match any tariffs that other nations are putting on their goods. Now, there's very little details on how this would work. But it again highlights the difficulty in administering tariffs. Like, how's the US going to figure out like what other countries are charging on their goods? Is it going to be, based on an average, based on specific goods?
Right.
What if they're only selling, but they're not buying the same goods? So it's this is very complicated, and I think it really just injects uncertainty that people seem to be ignoring in their equity investments right now.
Fair enough. Maybe we'll move now to Jerome Powell. He was testifying before the Senate Banking Committee this week. What did you learn from that testimony? Anything new there?
Yeah, so it's a lot of talk about the testimony, but I think there's sort of a bottom line that came from that testimony, and I would say the bottom line is that it was a slightly more hawkish tone. It's looking more and more like the Federal Reserve is in a wait and see mode. It's also looking more and more like the next meeting, which is in March, will be a skip meeting and there won't be a policy rate decrease. Jay Powell really emphasized the strength of the economy. And I think his exact words were something like that time was on their side before cutting rates again. So, I guess in that sense, it was a little bit of new information, but more from a nuance. But I think the sort of funny thing that happened in the midst of his testimony was halfway through the 2-day testimony, we received the CPI data for January.
Right.
And this data showed that prices are actually increasing. So the CPI rose 0.5% month over month, which is a lot, and the core rose 0.4% month over month. Um, this was fueled by a few things. So it was sort of more general: car insurance, airfare, prescription drugs, and of course on the CPI number, food costs, eggs specifically. Um, but the 12-month trend is now up to about 3%, and this hit a low of 2.4 in September. So this is kind of at the upper bound of um, the Fed's targeted range. And this is really important because this reinforces this view that it's time to sort of watch how things are going to play out. But this is also really important because if you read, I would say universally, any economist or any expert on the economy, they will comment that tariff policies risk being inflationary. And if that's true, which I believe that it is true, you want to be starting from a very low base for inflation. You don't want to be starting from your upper edge of the boundary here. So the market actually, had a little bit of consternation around the CPI number because it recognizes that support from the Federal Reserve is just not, as in cutting interest rates,
Right.
is just not going to be there. And all the economic data is actually, quite good. So the good news is we have a pretty decent economy in the United States. And so we did see a very negative reaction to the CPI number from treasuries. Yields bounced in response. So rates have been trending higher on the back of the testimony and the CPI data.
But in contrast, I guess, to Trump's clear desire to see lower rates, which he's been quite vocal about, and I guess maybe to play devil's advocate or to push back on the idea of tariffs, particularly, which again you think are more likely than not. A lot of economists believe it's for sure inflationary, but sort of a one-time price adjustment that the economy or the inflation numbers can then absorb, and something that the Fed might be able to digest. But based on that, and I guess the rising CPI, is there a path at all where you'd see lower interest rates in the US?
Matt, I think two things. One, I think you highlight a really important nuance, which is the level of prices versus a consistent change in prices. And it is true. If you saw a tariff and there was a one time shock, you would have that sort of one time bump, but then you would just hit a higher level of pricing. It doesn't mean that you have consistently higher prices. You need continued action that impacts prices to have consistently higher prices. So I think there is some validity to that thesis. And that is, I think, the story around, one-time shock. And even President Trump has said, there could be a little bit of pain through this dislocation period, and then there would be normalization. And interestingly, also on social media today, on Truth Social, Trump posted that interest rates should be lowered, something which would go hand in hand with upcoming tariffs. So To me, that still makes absolutely no sense.
Sure.
But I think your question is the right one. And so let's sort of take this back to economics 101. And okay, so yeah, let's say tariffs do increase prices. It's a one-time increase. Consumers adjust. Fine. The issue is actually the economy. So, what does all of this do to the economy? Because a
Right.
strong economy will actually give you that inflationary support for continuous inflation. And this is exactly what we saw, in addition to the supply chain impact, which we could see here too, by the way, um, coming out of the pandemic. And so you've got, a strong economy boosted by a lot of domestic investment in the US, um, and that itself will be inflationary. And that would be sort of more continuous as long as the economy continues to grow above expectations. And there are lots of aspects that could fuel higher costs. So, we talked about tariffs. Then there is immigration policy. A decrease in population or working age population could be inflationary as well. You all of a sudden have upward wage pressures. You've got to pay people more to attract them into different jobs. So, all of the things that we experienced coming out of the pandemic for a whole host of different reasons could actually come back into the inflationary calculus. And so, the point I'll end on here is probably the only path to lower rates, and nobody's going to like to hear this one, is an economic slowdown.
Right.
So, that's a bit contradictory to what we're trying to do here, which is to continue to invest and grow the US economy. And I say we, I mean, this is what the government is trying to do. So those two things don't really go together very well based on, hundreds of years of economic theory.
Sure. So fairly difficult to see at least short-term rate declines is what I'm taking away from that. Is that fair?
Yeah, I think it's going to be really difficult. And I think the only thing that's going to give you lower rates in the short term is if you see disappointment in the US economy. And I don't see that on the horizon right now.
Let's turn back to Canada. One of the biggest stories, not just this year, but I'd say for the past several years, has been the weakening of the Canadian dollar vis-a-vis the U.S. At least. And what we've seen in the face of sort of bad tariffs is actually a counterintuitive bounce of the Canadian dollar. What's behind that strength, and how do you sort of square those two facts?
Well, just so that our listeners go, "What? That doesn't make any sense." um, we did have the initial sell off in the Canadian dollar when the 25% tariffs were announced, and then the Canadian dollar has actually rallied, and on a year to date basis is up from its December 31st levels. I personally had the view that as soon as our prime minister announced his plans, and I assumed it was to resign, that the Canadian dollar would start to bounce. The Canadian dollar had, as our listeners likely know, because we feel it every day, had been selling off throughout most of 2024. And that was really related to the relative economic outlook between Canada and the United States, and the fact that the Bank of Canada was going to have to cut a lot more aggressively. And so I think that that's the most important factor in determining how the Canadian dollar does here. And of course, with tariffs, that's going to impact the Canadian economy much more than the US economy, and the Bank of Canada will have to get more aggressive. Um, but I think what's caused the bounce in the Canadian dollar here has been primarily the prospect of the Canadian dollar had moved down so much and it was really oversold. And I think we're having a little bit of a short covering rally here. So, what I would expect for the Canadian dollar is that it continues to trade in a trading range, unless we have, a real adjustment in our expectations. And where that would come from is if you remember, we only have a 1 month reprieve on the 25% blanket tariffs.
Sure.
If there was the view that we were going to have 25% tariffs on all goods coming from Canada, and then Canada reciprocated, we'd be pricing in a much more dire economic outlook. And that would take the Canadian dollar down from these levels, which again is more evidence that um, markets, big picture, markets are not fully pricing in the full tariffs that have actually been announced, yet not, implemented or announced and are currently temporarily paused.
And I guess the reverse of that. So if the 30 days does pass and the tariffs are not enacted or enacted to some far lesser degree than was initially threatened, would that be enough to catalyze a appreciation of the Canadian dollar via USD, or do you think that's where we currently sit and there's really just more downside?
Yeah, no, I think that would definitely catalyze a bigger bounce in the Canadian dollar, mostly because I think people are positioned still against the Canadian dollar or short the Canadian dollar. So I think on a basis of just short covering, you would continue to see the Canadian dollar appreciate because I think it really depends. I don't know what the number is, but some level of tariffs is probably priced in,
Sure.
just not the worst case scenario.
Let's talk a little bit about equities. You clearly sit as a CIO of equities, so we'll get into your expertise a little bit. I'd love to get your comments on what's happened year to date, who's doing well, and then any outlook for equities.
Yeah, so thank you for asking about my favorite topic. Um, I've been waiting for this part of
How
the
much macro to get
discussion
through
today.
first, you know?
Yeah, I know, I know. We have to set the stage
Yeah,
or set the table. Um, yeah, where to begin? Well, let's just start with it's been a surprising year. If you look at the leaderboard, European equities, like if you were just sort of dropped in from Mars kind of thing, you'd be surprised to see what's happening here. But European equities are doing really well. You've got equities in Hong Kong also doing well. And believe it or not, in the face of all this, um, which is also shocking. Canadian equities are up on the year, and they're actually outperforming US equities. So this is a complete reversal of trends over the last couple of years. And so let's sort of take each of these one by one to figure out what's happening. And I think I'll start across the pond and I'll sort of end up here in North America because I think Europe has been the biggest surprise and understanding what's happening in Europe. Now, obviously, European equities, because they've been so out of favor for so long, have much more attractive valuations than U.S. equities. But that's not really a reason that people are starting to buy uh, European equities. But I think you have to think in the literal sense that many investors were very overweight U.S. equities, and so I call it, the people moving out the big door and going through the small door problem, which means, they're selling something that they own a lot of and it's a very crowded trade. Everyone's in this US equity trade. And as soon as there's a shift towards something else, the liquidity becomes a problem and you can really push up stock prices very quickly because they're just so underowned. So I think that's part of the problem. European equities were very underowned. European financials have been benefiting from pretty dovish central bank policy. So you've seen pretty universal central bank cuts in Europe. I think maybe optimism about the resolution of the Russian and Ukraine war. And then the final factor would be a view that China is finally bottoming from its own property crisis. And the idea that there could be increased demand for luxury goods, European luxury goods, from Chinese buyers. So there's a few things that are happening. Is this sustainable? I'm really not sure if I'm being honest, but I think those are all the factors that are leading people to start looking at, more diversification, which we always advocate for, away from the very crowded momentum trade in the US. Reinforcing that is if you look at the Mag 7 stocks on a weighted basis, they're basically flat on the year.
right.
One of the stocks is primarily driving returns, which is Meta. So it hasn't, you haven't been rewarded by owning those stocks this year the way you had over the last couple of years. So it starts to get people thinking that on a relative basis, I need to spread some of my risk around, and I might be too concentrated in those names, particularly if you own, the S&P 500. Um, you're going to be fairly heavily weighted in the Mag 7 names, and so that's weighing on your performance. I want to bring it back to North America here, and Canada. I mean, Canada has some unique attributes in the context of what's happening right now. But one of the things that we haven't talked about yet is the strength of gold. And so the mining sector, particularly the gold mining sector, has been quite strong in Canada. So you have very high prices in gold as well as a weaker US dollar. Very good for Canadian companies, particularly if you're a Canadian producer. And in the context of most commodities, you're trading in US dollar pricing.
Right.
And so again, for Canadian companies, that's very good for earnings. And then you've got things like, in the services sector, less impacted financials, also less impacted by the tariff calculus. I'd say where financials could get hurt is on the economic outlook, but from an earnings perspective, any company in technology, financial services should do quite well, even in the face of tariffs, which are very much targeted to the manufacturing sectors.
Really wonderful, comprehensive overview. I appreciate you coming and sharing your thoughts. I can't wait to have you on again.
Yeah, I think we're going to have lots to talk about in 2025 and onward.
No doubt.
So I look forward to making it all make sense for you and our listeners.
Thanks, Leslie. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.